Let's say you've got $100,000 sitting in your brokerage account. You want to put it to work, not in slow growth index funds, not in risky crypto, but in something that pays you now. Enter MSTY and ULTY, two explosive high-yield ETFs from the YieldMax lineup that have caught fire in 2025. But here's the million-dollar question, or should I say $100,000 one. If you had to choose between MSTY or ULTY, where should your money go? Which one could potentially pay you more consistently, and with less risk of blowing up your portfolio? Let's break it all down. First, what are MSTY and ULTY? These aren't your typical dividend ETFs like SCHD or VYM. MSTY is the YieldMax MSTR Option Income Strategy ETF. It uses a covered call strategy on MicroStrategy stock. Yes, the same company that's been hoarding Bitcoin like it's going out of style. Meanwhile, ULTY is the YieldMax Ultra Option Income Strategy ETF. It holds a diversified basket of about 118 U.S. large-cap stocks and generates income via covered calls across the portfolio. ULTY isn't tied to one company. That spreads out risk. Both MSTY and ULTY are designed for one thing: massive income. And we're talking real numbers. As of recent data, MSTY has a trailing 12-month yield of around 130%, while ULTY comes in a little lower, around 120%. These aren't typos. These are the real annualized yields as of mid-2025. So what does that mean if you put $100,000 into either of them? Let's do the math. If MSTY keeps up its current yield, you're looking at roughly $10,800 a month in income. That's right, over 10 grand every month. Meanwhile, ULTY with a slightly lower yield could bring in around $10,000 per month. Still a strong number, especially for passive income. But hold up, high yield doesn't come free. Both MSTY and ULTY are tied to extremely volatile underlying stocks. MSTR, which MSTY uses, is notoriously volatile because it's so closely tied to Bitcoin. MicroStrategy has been leveraging its balance sheet to buy BTC, so when crypto moves, MSTY moves too, sometimes violently. ULTY is diversified, so while it's still volatile, it moves more smoothly given broad stock exposure. But it's still option income driven, so it's not stable like a broad index ETF. And here's where it gets interesting. The way these ETFs generate income is by selling call options on their target stocks. This covered call strategy limits the upside potential of the ETF. So if stocks go on a massive bull run, you won't fully participate in that growth. That's the trade-off. You're collecting high income now, but capping your gains later. So back to our main question. If you had $100,000, which one should you pick? Let's go deeper. Let's examine volatility. MSTY recently traded between about $17 and $28. ULTY has ranged between $5.23 and $12.63. ULTY's swings aren't trivial, but its breadth of holdings means one disappointment won't tank the fund. On income consistency, MSTY pays monthly, typically between $1 to $1.30 per share. ULTY pays weekly, around 10 to 12 cents per share each week, which annualizes to that 120% yield we saw earlier. Let's zoom out and look at a $100,000 investment over 12 months. MSTY. Average dividend per month, approximately $1.10 per share. Share price, approximately $20. You'd own 5,000 shares. Monthly income, approximately $5,500. Annual income, $66,000 ULTY. Average dividend per month, 0.45 per share. Share price, 6.26. You'd own 15,974 shares. Monthly income, 7,200. Annual income, 86,400. So ULTY might deliver more income, not quite double MSTY, but close, and with broader exposure. And let's not forget tax implications. These aren't qualified dividends. Most of the income is considered ordinary income, meaning it's taxed at your regular income tax rate. So if you're in a higher tax bracket, your real yield could drop significantly. Now here's where strategy comes in. Many investors split their money, $50,000 into MSTY for its extreme yield when Bitcoin volatility spikes, and $50,000 into ULTY for steady weekly dividends with better diversification. That blend gives frequency and income but hedges some volatility. But let me be clear, these are not buy and forget ETFs. You have to actively monitor them, watch the yield sustainability, the underlying stock performance, and market conditions. Covered call ETFs can get crushed in a strong bull market, and they also underperform when volatility dries up. So, who are these ETFs actually for? MSTY and ULTY are best suited for income-focused investors looking for high monthly cash flow, those okay with limited capital appreciation, people who understand the risks of options-based ETFs, and those using this income to supplement a diversified portfolio, not bet the whole farm. Now, if you're retired or semi-retired and want monthly income without touching your principal, these could work, but only as a piece of your broader portfolio. You wouldn't want 100% of your retirement savings in MSTY or ULTY. That's too risky. And what about younger investors? Well, it depends. If you're chasing growth, these won't give you the upside of VOO, QQQ, or a tech-heavy growth fund. But if you're building a cash flow engine to reinvest dividends every month, and you're comfortable with the swings, they can be powerful. One final note. Always look beyond the yield. A high yield is meaningless if the ETF's price crashes and burns. Total return matters. That's price plus dividends. If MSTY pays 130% but loses 40% in NAV, you've got a problem. So MSTY or ULTY? MSTY offers higher yield, but with more risk and single stock exposure. ULTY pays nearly as much, with weekly distributions and more diversified risk. Or better yet, split it down the middle, monitor closely, and don't get greedy. And remember, no ETF is a magic money machine. Understand the risks, diversify, and invest according to your goals. If you found this breakdown helpful, make sure to hit that like button and subscribe to Money Stick Unfiltered, where we turn faceless finance into fearless knowledge. New videos every week, real talk, no fluff.